Does lowering interest rates bring inflation? How about rising government debt? I'm Richard Vague with Tycos. Of all the widely held beliefs regarding the economy, perhaps the most firmly entrenched is the belief that lowering interest rate brings higher inflation, and the seemingly conflated belief that rising government deficits and debt brings higher inflation. It's genuinely hard to find anyone who is not at least vaguely aware of these theories and blithely bought into them. The latter of these is often expressed with the phrase, quote, "the government printing of money brings inflation," end quote. Yet I've found that people generally can't even define what it is they mean when they say the government prints money. I would further note that when Volcker acted to curb inflation through ultra-high interest rates in 1979 through 1982, he was acting on a completely different theory from either of these. The monetarist theory, whereby economists believed that it was sharp increases in the money supply, which is primarily deposits, that bring inflation, not an increase in government debt, which was actually going down as a percent of GDP when Volcker began his assault on inflation in the 1970s. As regards Volcker's monetarist theory, which came from sources like Milton Friedman, few people realize that these two things, increases in federal debt and deficits on one hand, and increases in the money supply on the other, are completely different things. The money supply that Volcker was measuring and acting upon with his high rates was M2, which is almost entirely made up of bank deposits, plus currency in circulation, which is the much smaller part of the total. If we look at total bank deposits and currency in 2000, was 5.4 trillion, and by the end of 2025, it was 23.7 trillion, an increase of 18.2 trillion. 85% of those deposits were created by bank lending, and only 24%, a comparatively smaller amount, came from Fed open market operations. Technical note, other banking activity actually decreased deposits by 9%, and when we factor that in, we are at an even 100%. So, stated simply, most money is deposits. Government debt is a completely different thing. It's the securities, bonds, and bills, now famously totaling $38 trillion, the government issues to fund deficits. Let me say it again. Money, the money supply, is bank deposits, which people spend and totals $23.7 trillion currently. Government debt is Treasury securities and totals $38 trillion. Government securities can and sometimes do increase rapidly in ratio to GDP, while the money supply deposits are declining or growing only slowly, and vice versa. So now let's get back to our two questions. Does lowering interest rates bring inflation? And does rapid growth in government debt, as measured in ratio to GDP, bring inflation? It's a very easy thing to check, since in the U.S., since 1950, there have been only 7 periods where short-term interest rates declined by 200 basis points or more, not merely the kind of measly quarter point, which is the amount of the reduction that the Fed frets openly about, but a full 2 percentage points. And separately, there have been only 3 periods when the government debt to GDP genuinely increased rapidly. So first, let's look at the 7 times when short-term rates have declined by more than 200 basis points. In 6 of the 7, inflation went down when short-term interest rates went down. The one instance where prices went up was COVID itself, and in that instance, the supply chain decimation, workers couldn't work in factories for a period of time, was the culprit. We would note, as we have previously, that linked month inflation plunged in July of 2022, which was before the Fed applied its presumed antidote of higher rates. In the famous 1970s bout of high inflation, the one that struck fear into the hearts of all the economists of that era and frankly persists to the present, Inflation went down in the very periods that the Fed was lowering interest rates, and inflation increased in the period when the Fed was increasing interest rates. You see, the famed 1970s inflation had everything to do with the fact that the price of oil went from $3 a barrel in the early 70s to over $39 a barrel at the end of the 70s. And we were a gas-guzzling nation in that decade. It would be as if today the price of $58 a barrel went to over $760 a barrel, just to give you a frame of reference. You analysts should know that in what we've just told you, we're using average rates for whole years here, and our short-term rate in is the bellwether 90-day T-bill rate. We could have used any other time markers instead and used the Fed funds rate instead and come up with, in essence, the same answer. So, with all that, there is not a compelling case in any of this that lower rates bring inflation. Feel free to look at the data yourself and slice it any way you want and send us contrary case you want us to look at. We think you might find it doesn't exist. It's not a hard or subtle analysis. Next, let's look at the 3 periods of rapidly increasing government debt. The first was 1981 to 1993, when, under Reagan and then Bush 1, federal debt to GDP exploded, more than doubling from 32% of GDP to 66%. During that period, inflation and interest rates fell from 10.4% to 3.0%, and from 13.7% to 3.0%, respectively. The second period was 2007 to 2012, when, because of the global financial crisis, federal debt to GDP again exploded from 64% of GDP to 101%, and inflation and interest rates again fell from 2.9% to 2.1%, and 4.3% and 0.1%, respectively. And finally, during COVID, from 2019 to 2020, when it jumped from 108% to 130%, and inflation and interest rates fell. Inflation fell from 1.8 to 1.3%. As you all well know, just 2 short years later, average annual inflation jumped to 8%. This is the painful and politically consequential jump. But it was actually in a period when federal debt to GDP was declining to 121%. In the 1970s, the most famous period of high inflation in post-World War II history, the famous Jimmy Carter oil price and OPEC inflation we just mentioned, inflation reached at one point an annual average high of 13.5%. Government debt to GDP at that moment was actually declining from 35% to 31%. We actually did a comprehensive study on this way back in 2016, studying 47 countries over 50 years, and saw no correlation between rising government debt and rising inflation. You can find a link to this study below in the description. Our overall summary of this study was that there were 85 instances where government debt growing 60% plus over 5 years, and in 68 of those instances, it did not lead to high inflation. There were also 40 instances where government debt grew 200+% over 5 years, and 32 of those instances did not lead to high inflation. Finally, there were 47 instances where government debt to GDP grew 20+% over 5 years, and 41 of those instances did not lead to high inflation. So there's really no case to be made. And for those of you that believe high government deficits do bring inflation, we ask you to provide us with that evidence. And I would ask you to do that for the 80-year period from the end of World War II forward, and in a developed economy, one of the larger economies. You simply won't find much, while you will find an avalanche of evidence to the contrary. Our guess is that folks who believe in that link have to refer to pre-World War II examples like the famed Weimar Republic German inflation of the early 1920s, or the American Revolution, or post-war examples in undeveloped third world economies like Zimbabwe, which are very different creatures since they have to borrow in a foreign currency and have to import so much. What those folks did that got them in trouble was neither issuing government bonds nor creating money by bank lending. Instead, it was the literal printing of vast quantities of currency in lieu of issuing government debt, which is a very different thing. We'll get into that next week. We apologize if this all seems like much ado about very little, since there is such a deeply embedded belief that rising government debt or lower rates bring inflation, and there's such a big benefit to be gained by lower rates, it deserves this level of scrutiny. We'll look at the American Revolution, the Weimar Republic in Zimbabwe, and the actual printing of money, and the crucial difference of that with what we do now in developed economies next week. We just wrote a book on the financing of the American Revolution, so we happen to have that data handy. It should be fun. See you next week.